Welcome everyone to our first open webinar from the GA Risk Conversation series. We are delighted that you could join us and to see so much interest with over 100 participants, and we can see the numbers of people coming in and joining increasing as I speak. Just some very quick housekeeping first. Participants will be on mute by default until we reach the Q&A session. And during the Q&A session, you can see there is a question box for you to submit questions, but we would like a livelier session than that. So we highly recommend that you use the little hand icon that you can see on a small dialog box. If you click on that, one of our programmers will be able to unmute you and you can talk directly to us and the panelist. So let me start again. So good morning, good evening, good afternoon, depending on where you are in the world. I am Adrita Bhattacharya-Craven, and I am the Director of the Health and Aging Research Team at the Geneva Association, and I'll be moderating today's webinar. I'm joined by Dr. Kai-Uwe Schanz, Head of Research and Foresight at the Geneva Association. And our special guest today is Mr. Mike Mansfield, Program Director of Aegon Center for Longevity and Retirement. The title of today's webinar is The Life Insurance Puzzle, Protection Against Mortality and Longevity Risk in Uncertain Time. And before we get going, I wanted to provide a quick context and to try and understand why we are trying to talk about this now. Life insurance penetration in mature economies has been declining for the past 2 decades. And this decline has been partly accelerated since the 2008 financial crisis. In OECD countries, the market share of life insurance has fallen from 5.4 to 3.8 during this period. The paradox, the relevance of life insurance products to our societies is now greater than ever. We have a rapidly aging world, and we need financial instruments to help with helping people age better with the different comorbidities that we see. Old age poverty is all too prevalent in many countries, and the effects of major global events like COVID-19 has already made a dent on pension assets, caused increased unemployment, and is exacerbating the problem. Historically, life insurance products have had a critical role to play in financing people's lifestyle and care in retirement. So why do we see this inverse trend of what is needed versus what is demanded by the market? And this is where Mike and Kai comes in, who have been working on this and trying to understand the conundrum. So without further ado, let me go to Kai. Kai, may I bring you in at this point and ask you to share some of the highlights and the key messages from your recent publication at the GA. Thank you.
Thank you very much, Adrita. Welcome everybody to this webinar. I'm delighted to share with you the findings from our most recent research paper. Moving to slide 6, please. I will kick off by examining how the life insurance industry's relevance has developed over the past few decades. On that basis, I will examine the many obstacles which hold back demand for life insurance, and finally, so what can be done to stimulate the demand for life insurance. Moving to the next slide, slide 7, please. Here you show actually the long-term development of life insurance penetration, to which Adrita alluded to, the picture for 7 mature economies. Life insurance penetration, as you will certainly know, is defined as the share of life insurance premiums in overall GDP. The picture we are seeing here is quite a sobering one. In the US and Japan, penetration levels have fallen back actually to levels that we last saw about 35 years ago. In the UK, Germany, and Switzerland, the respective setbacks, if you like, are between 20 and 25 years. What is really striking to see from this chart is the close correlation between macroeconomic factors and life insurance demand, especially for life insurance products that are sensitive to capital market developments and to interest rate developments. So the bursting of the dot-com bubble, the global financial crisis, where were very, very important events with a significant bearing on life insurance demand. Slide 8, please. Now, the key question, of course, is what is behind this apparent tale of erosion? And before zooming in on the life insurance specifically, let me take a look at the insurance industry as a whole. The findings on this slide here are based on a customer survey which the Geneva Association commissioned recently. This survey covered 7 mature economies, the economies which I have shown on my previous slide. The left-hand figure here highlights the specific deficits in customer experience reported by the survey participants across all lines of business. And the top, pain points, if you like, are claims, second, complexity, and third, perceived value for money. On the right-hand side, you discover that only 22% of the respondents that participated to the survey consider the insurance industry trustworthy and acting in the customer's best interest, with some interesting country-specific variations. Of course, these overarching roadblocks, if you like, to insurance demand have been identified before in some form or another, but our survey clearly confirms their continued relevance. Moving to slide 9, please. Slide 9, which actually zooms in on the life insurance specific findings of our customer survey. The figure here highlights that a lack of awareness and knowledge is a root cause of underinsurance in the life sector. 60% of the survey participants were not aware of basic wealth accumulation products such as endowments or unit-linked products. On the other hand, at the other end of the extreme, maybe not surprisingly, the term life insurance is much better understood, with only 1/3 of respondents saying they never heard about this relatively simple product before. Now, moving on to slide 10, and here it gets really interesting because we probed those survey participants who already purchased life insurance, so our existing customers, if you like, about their motives. Why they're buying motives. And for term life insurance, as you see on the left-hand side, the desire to protect one's family clearly stands out. And maybe interestingly, trust in insurers and the pure cost-benefit characteristics of the product play a secondary role only. Now, the same question about retirement annuities on the right-hand side reveals that for our existing customers, investment considerations took center stage when they bought annuities. And interestingly, specific concerns about the adequacy of retirement savings were less frequently mentioned. By the way, when you look at the publication, which is available on the Geneva Association's website, you will find plenty of data for the 7 individual countries if you are interested in digging deeper. Now, slide 11, please. We also probed those respondents who have not yet purchased insurance, but who have expressed a firm intention to do so in the near future. So we are looking here at our prospective customers, if you like. And the pattern is quite similar to the previous slide. For term life insurance, the need for protection clearly stands out. This is what we would have expected. Moving on to slide 12, please, which gives the rationale behind planned purchases of retirement annuities. And it's interesting to notice that prospective buyers are primarily motivated by the need to be prepared and also motivated by concerns about the adequacy of social security benefits. Whereas, as you may remember, for existing customers, investment considerations did actually rank much higher. So that is an interesting difference between existing customers and prospective customers. So let us move to slide 14, please. And this is shedding light on the behavior of those people who declare that they have no intention whatsoever to buy insurance at any time in the future. And as far as term life is concerned, affordability is the most relevant perceived barrier. followed by a lack of knowledge. And on slide 15, we have a quite similar pattern for retirement annuity insurance, with a lack of awareness ranking slightly higher as a roadblock than affordability concerns. So much for the empirical picture. Moving on to the next slide, please. In addition to all these survey findings, the publication also offers a thorough overview of the theoretical state of the art in explaining for obstacles to life insurance demand. And basically, we can distinguish here between behavior, economics, and social demographics. I don't have the time to go through all these areas, but maybe just focusing on the behavioral part. Moving to the next slide, please. The most interesting one, because as we all know, traditional economic theory is not particularly helpful when it comes to understanding what actually drives the purchasing behavior of our customers. So what we did, we reviewed the relevant literature and consolidated it into what we call an octagon of behavioral bias in insurance buying. And maybe going clockwise, just highlighting a few of them, framing. Of course, it matters greatly how propositions are being framed, how they are being presented. Think of annuities. You can frame annuities as investment products, but you can also frame annuities as protection products, which secure a certain standard of living post-retirement. Anchoring is also quite interesting, describing individuals' unconscious use of arbitrary or simply irrelevant information. For example, when thinking about life expectancy, many people refer to their parents' or grandparents' life expectancy and ignore the fact that we have a strong underlying general trend towards increasing life expectancy, which can then easily result in insufficient provisions and insufficient funding levels. Maybe the final example, loss aversion, very relevant to our industry, of course. So many people, for many people, the pain of a loss exceeds the joy from a gain or of the same amount, and that can help us understand why annuities are not that popular, especially from an investment perspective. If people factor in the scenario of an early death, which they attach to a higher weight than the potential gain in case of a long life. So that would be a specific example of the relevance of behavioral finance and insurance to understanding real life buying behaviors by our customers. My final slide is about the so what, the recommendations or conclusions for the insurance industry and some of their stakeholders. You are, of course, familiar with many of these recommendations. The first one, new products, review of products. I think the key challenge here is to move away from interest rate sensitive products, and a lot has been achieved here already, such as hybrid products, hybrids of unit-linked and traditional products that have been introduced to a number of markets already. But more recently, we are also seeing in this context a more ambitious development, so shifting entire business models, if you like, from focus on protection only to a broader proposition that includes prevention and preparedness. The second item is to reduce price sensitivity through value enhancements. We have seen from our survey that most people consider life insurance as complex, as opaque, as difficult to purchase. So the case for product simplification is obvious, and in the life space, one example might be accelerated underwriting, leveraging advanced analytics. The third one, very relevant, of course, as well, the potential for enhanced cost competitiveness. Many people have expressed issues about affordability, about the perceived cost-benefit characteristics of products. So what can be done on costs? And of course, what comes to our mind first here is distribution. But that is not as easy as it may sound. Our survey findings clearly reveal that people would like to maintain access to the agency channel. So moving the entire life insurance business online is not a viable proposition for a large number of people, including the millennials, by the way. That might work for simple term life products, but definitely is more difficult for more complex propositions, and that limits the scope for radical cost savings in the life insurance sector. And last but not least, again, insurance awareness and education, the lack of awareness and knowledge, a long-standing issue, has been discussed many times for years, for decades, but it continues to be of utmost relevance. And the conclusion here is that the industry associations, our stakeholders, have to redouble their efforts to tackle this issue. With that, I would like to stop and back to Adrita.
Thank you, Kai. That was really very useful and insightful, and really helps us to understand some of the demand side of the market and what's going on. Perhaps I should now bring in Mike. And Mike, if you wouldn't mind coming in and sharing with our audience some of the work Aegon has been doing around retirement readiness. So over to you, Mike.
Thank you, Adrita, and thanks, Kai, for that great presentation as well. So my name is Mike Mansfield, and I work for, excuse me, for Aegon, and we're a life insurance, pension, and asset manager based in The Hague in the Netherlands. And within Aegon, I am the program director for our Center for Longevity and Retirement. And before we dive into the presentation, maybe give you a little bit of background in terms of what we've been doing in the research over the years. This is our 9th year now doing our Aegon Retirement Readiness Survey. And within the survey, we cover 15 countries around the world. And our reason for doing it is we want to measure and look at people's attitudes and their readiness for retirement. And we're doing this really so that we can raise awareness about many of the issues we're talking about today around retirement preparation, security for older age, but also to stimulate a dialogue about the issues and the trends and the opportunities for us as an insurance sector, but for other sectors as well, in terms of helping people live long, prosperous lives. So before, again, we dive in, maybe a good idea to put a bit of context around what we're going to talk about today. We all know that increases in longevity and advances in medical science have really brought about a situation where we are living longer than we have in previous generations. We're spending more time in retirement, and that's really giving us an opportunity to rethink our life priorities and how much time we're spending in retirement. And I think what we've seen is coming into the pandemic that our current social contract between governments, employers, and individual had been coming under financial strain. But now with the need for a redistribution of resources, that our governments are really having to support healthcare systems around the world, but also having to redistribute money to support businesses and enterprises, that is going to come under more financial strain, and we probably are looking at some troubled economic times ahead of us. But in that context, individuals are having to take on more responsibility for preparing for their retirement, but many of them really are ill-equipped for doing so. And it's within that context that we really want to look at what the role of social partners are, and us as financial services to see how we can develop the products and services that can help people achieve that lifetime of financial security and make sure that nobody is left behind in preparing for retirement. So maybe we could move to the next slide and have a look at the future of retirement and what that is going to look like. So here we've got some facts from our 2019 survey. And we asked, one of the first questions we asked people was really to put a dot on the horizon and tell us what their aspirations were for their retirement. And what we see is that people see their retirement as an active phase of life, one where they want to do things like to travel, to spend time with friends and family. But I think it's important to realize within that context that to be able to do these things, you're going to really need to have two things under control. And one is you're going to need the money to do these things, but also the good health to be able to enjoy them. So it's interesting within that to think about the next question you'd logically ask somebody. If this is what you want to do, what are your concerns? What's really worrying you in terms of preparing for your retirement? And we can see when we ask people, or gave some people options about what concerns are for their retirement, the two top concerns were related to declining physical health and running out of money. And that gives us an opportunity as insurance companies to see how we can help people overcome those two concerns and what we can do to help them. It's not surprising then when you look at the concerns people have to see that 3 in 10 people say that only 3 in 10 people say that they're confident that they will be able to achieve a comfortable retirement. And that really is an area of concern and one that we would like to see where we can help people. So I think in turning to the next slide, what we want to do is to see how can we empower people in this transitioning world. And what we looked at in our research last year and have been speaking about over the past couple of years is that there really are 5 fundamental areas where we can help people to prepare for their retirement. And the first of those is to see how we can encourage people to start saving early and to develop a habit of saving habitually for their retirement. And in looking at the results of the survey, what we found, and it's a fairly consistent number over the years we've been doing the research, is that 39% of people say that they are always saving for retirement, which means that there really is an opportunity for us to engage other people to really bed down that habitual saving habit. The next area is to look at developing a written plan. And here we feel a plan is important because it really will help clarify people's priorities and their aspirations for their retirement and help them make sure that they're on track to it. So the finding finding coming out of this question we asked was that only 16% of people said that they had a written plan for retirement, meaning again, there really is some room for improvement here. But having a plan is very important, but it is very important as well to have a backup plan for unforeseen events. Catastrophic events can happen to households, and it is important, therefore, to have a plan that includes a level of protection, but also something to fall back on when times get tough. The next area, the fourth area, was really to look at developing a healthy lifestyle. And here what we want to do is to make sure that people stay healthy so that they can stay economically active. And again, as I said earlier, enjoy the things they want to do when they come to a point in time when they choose to retire. And the last area that we highlighted as a fundamental was looking at lifelong learning. And I think this really breaks down to 2 areas for us. One, looking at financial literacy and the importance of people having the financial literacy skills to be able to understand financial matters and plan for their future, but also to make sure that they keep their skills up to date as they're going forward. So maybe we'll have a look now at the focusing on habitual saving and what we can do to encourage healthy behaviors. We asked people in the survey what were some of the barriers they had that were preventing them from taking care of their health and saving for retirement. And in terms of saving for retirement, the top responses were looking at not earning enough. 35% of people said that was their barrier to saving, but also people having other priorities. And these were very similar responses when we asked people about what's preventing you from taking care of your health. Again, people focused on money and time one. People saying that they couldn't afford to spend the money, around 25% of people said that. And another quarter said that their work hours were preventing them from taking better care of their health. So I think in looking at those two barriers in terms of what's preventing people from doing or engaging in the behaviors we'd like, you can see it breaks down to looking at time and money. And I think building on the work that the Geneva Association have done in looking at behavioral economics, what we have seen is that behavioral economics are a powerful nudge in helping people to prepare for the future. 46% of people told us that, workers told us that lifestyle nudges, like turning a certain age, was the thing that got them started on saving for their retirement. But I think one area that is an important area to consider is the workplace and how important that can be in terms of getting people started on the journey towards saving for retirement. A total of 42% of people said that the workplace was the area that got them to start saving for their retirement. And you can see here on this chart on the right-hand side, that 18% of people said that their employer paying into their retirement plan was actually the nudge. And in looking across the countries that we did this survey in, you can see that in countries like the Netherlands, the United States, and the UK, where they have a stronger environment of workplace savings, that these nudges were even higher. So in the Netherlands, it was 29% of people that this nudge really was a strong nudge to get them started for saving for their retirement. And I think in looking at this, one area we can look at something that has worked well in the past is looking at programs like automatic enrollment programs that enroll people in saving for their retirement by taking payroll deductions at source. And that does, in terms of people's concerns about not having enough money, we are helping people by taking money away from their paycheck before it actually lands in their bank account. So it is easier for them not to miss the money in terms of saving. And when we asked people how appealing they felt programs like automatic enrollment were, we found that about 2/3 of our respondents said that automatic enrollment would be an appealing way to get them to start saving for retirement. So maybe to summarize what some of the findings from our 2000 report are, is that I think we can see times are changing, responsibility is shifting, but that there is an opportunity for us as social partners to work together, that the solution is going to be a collective one, where traditional social partners work with new social partners. So I think we can see opportunities for ourselves as financial services companies to play a role in terms of developing products and services, but also providing support to help people understand how to prepare better for retirement. And I think we do play a vital role in that, in terms of helping people going forward in raising awareness for the need to take action. So hopefully we'll be able to discuss some of these findings in the Q&A session, but I think they very much mirror some of the very important work that the Geneva Association is also doing in this area. I'll hand it back to Adrita then.
Thank you, Mike. That was very, very insightful, and I think it also showed some of the parallels with the GA study. But you also brought out the role of the social partners and employers, and that is something probably we will discuss in a little while in our discussion session as well. And I'm sure audience will have some questions around that. But let me kick off the discussion sessions with some immediate questions that come to my mind before we open the floor to our audience. So perhaps start with the most topical issue of the day. So this is a question for you both. So please take your turns and just give us a sense in the longer term, how do you expect COVID-19 to impact on the life insurance industry? Perhaps, Kai, you can get us started and we move to Mike.
Yeah, sure. I'm happy to kick this off. Well, there are I think there are obviously both tailwinds and headwinds from the pandemic from an industry perspective. Let me start maybe with the positives. You know, given the extent of the economic downturn that we are experiencing, we will see a surge in public debt. We will see an erosion of government's tax revenues, and against this backdrop, the private life insurance industry can potentially play a bigger role going forward in public-private partnerships, in complementing public sector health and pension schemes. Of course, this trend has started has started pre-COVID, but I believe we could see an acceleration here. Another positive, if I may add this, is that the pandemic has certainly boosted people's awareness of mortality, morbidity, and health risks, and it has also highlighted the value proposition of the underlying insurance product. So these changes to risk perception could have a sustainably positive impact on demand. And another positive that comes to my mind, of course, is that we could see lasting behavioral changes from the pandemic that could positively affect the frequency and prevalence of more common diseases, where we have in a number of countries seen falling mortality rates actually in parallel to the COVID-19 crisis. So that's the positives. On the other hand, of course, what we are going through an economic contraction last seen 90 years ago, and that will heavily and adversely impact people's ability to afford insurance. I mean, this is almost a no-brainer, but I personally believe, and then I stop, that the longer-term positives will outweigh these negatives, which I would consider more short-term in nature and more linked to the current state of the economic and the business cycle.
Thank you, Kai. Mike, did you want to add to this?
Sure. I think I can build on many of the points that Kai has made. I think in looking at the industry that we're operating in the economic environment, indeed, I think the fact that we're facing into a time where we've heard here in the Netherlands anyway, on Monday, the Dutch Central Bank brought out a prediction that our economy was going to drop by around 6% this year, and are forecasting that the impact of post-COVID or the economic recession twice as big as the financial crisis. So I think for us as an insurance company, when we're going to have prolonged low interest rates and economic volatility, it's going to be more difficult for us to operate. But to many of the points that Kai brought up in terms of people's awareness of the need for protection, I think that's certainly come up because of the COVID crisis. And I think an interesting point you brought up earlier as well was, that we spoke about earlier, was in terms of how people are buying products. When I spoke with one of my colleagues last week, he indicated to me that in looking at how people are buying products and where the demand is, that there's been an increase in demand for simpler protection products that are often sold online, but the more complex products where people have face-to-face contact has been a dip. And I mean, I think that will change as we get back to work, but it does highlight that there is possibly an opportunity for us to continue finding ways to help people through various different channels. And we've probably seen an acceleration in terms of how we've moved into channels and where some opportunities are for us. So I think there are opportunities for us going forward. Our social role in helping protect people financially has never been greater. And we just need to navigate through this to make sure that we can do so to help people.
Thank you, Mike. I'm glad you brought out the whole subject of channels. And I think that leads me to the next question, which I actually wanted to pick up with Kai from your paper, Kai. You talk about low levels of trust in insurers. And clearly one of the major channels for life insurance has been intermediaries. So obviously that is a critical channel. And I wondered if your research looked into that and if you had any insights as to how trust relates to this intermediary action and sales and marketing and people's literacy, etc.
Right. Thank you, Adrita, for the question. Well, we actually covered this topic in a publication that we released late last year on the role of trust in insurance, where we also presented parts of our customer survey in the context of the agency channel. And what we found is that actually less than a third of the respondents considered the agents trustworthy. So the trust challenge is not limited to the carriers, but it also applies very strongly to the intermediaries. And so when the conclusion, I think, is pretty clear. If we really want to address demand issues for insurance, not from a carrier perspective, not from an intermediary perspective, we need to have a holistic approach which encompasses both the intermediaries and the ultimate carriers. And we are also referencing a few empirical studies that show very clearly that sales agents' behavior can either build or deplete customer trust, not just in the salesperson, of course, but also in the ultimate carrier. So I would refer all of you who are interested in that to our 2019 publication, The Role of Trust in Insurance.
Thank you, Kai. I'm just a bit conscious of time, and I'd like to move into our audience section. Just before we go, I wanted to pick up some of the themes that Mike, you had talked about in your presentation, which was around the social contract, which was around how 40% of you said 42% of the employer-led nudges has actually led people to start saving for their retirement. And in that context, I wondered if you could elaborate for us before we move on about what is that social contract, what are those social partners, and also what do you see as a role of the employers, because clearly the survey shows a relatively substantial number of people being influenced by employers particularly.
Thanks, Adrita. I think the social partners were the main social partners in terms of where people get their income are governments, employer retirement plans, and their own savings. And what we can see in terms of employers are a very important part of that equation. And I think it's often comes down to opportunity that we have with our employers. We have long-term relationships with our employers where we often receive a fixed salary and are offered retirement benefits. But the fact that we have a long-term relationship means that we have the opportunity to save long-term through employer plans. There's also, I think, an important aspect in that employers often have an awful lot of personal information about us. They know our birthday, they know when we change our benefits, if we have change in family circumstances. And to the points that we both did in our research looking at nudges, they can be very powerful nudges. So if you can see somebody is coming up to turning 40, turning 30, or had a child or something, you can use some of those nudges just to check in with them and see if there are opportunities to maybe save or change the way they save for their retirement. So great opportunities around raising awareness, but also opportunities to provide advice for people in terms of the way they save for retirement. So I think it's a question of opportunity and taking advantage of that opportunity to partner with people and use the trusted relationship that people have with their employer.
Thank you, Mike. Let's open the floor and start getting some questions in from our audience. I am mindful that a couple of questions have already been put forward through the little question function of the webinar software. May I ask you both that in the course of this session that you just raise your hand and my colleague will unmute you and you can directly talk to the panelists and ask your questions. So with that, let's have some questions in. Let's look out for any raised hands. And while we do that, perhaps we can go with the first question that was submitted to us. I think that was from Steve Casey, I believe. So it was a question for Kai. Kai, so did you dive into what was thought of for value enhancements?
Sorry, Adrita, can you repeat the question? I
think it probably would be best if Steve also came in, and if Steve could be unmuted if you are still around. Yes. Can someone please unmute Steve Casey? Thank you.
Oh, good afternoon. Can you hear me okay?
Yes, we can hear you very well.
Oh, fantastic. Thank you. Yes, no, Kai, very interesting, thank you. But I was particularly interested in the concept of enhancing the value of insurance products that you outlined on one of the points in the slide. In particular, I was keen to understand, did you dive into a little bit more detail to ascertain from a customer viewpoint what they actually mean by these value enhancements?
No, actually, what we did, we started with the pain points, with the perceived deficiencies of existing propositions, as I mentioned, the opacity, the complexity, the lack of ease in terms of buying. So this is where we started from, where we took the customer's pulse, if you like, and on that basis we came up with these recommendations. But we didn't ask the customers about what specifically they would like to see changed with insurance propositions. We didn't go that far.
Great. Thank you. We have, do we have any raised hands? Let me have a quick scan through. Okay, while they come through, why don't we go to another question that was submitted to us by, please forgive me if I pronounce your name in the wrong way, but it's Hidehiko Sogano. So it's a question to you both because it doesn't specify. Even there exists a high level of protection needs, I wonder if current regulation may hamper the capital-heavy business, so that lots of insurers are shifting away from traditional life insurance business. What is your view on regulatory aspects?
Sorry, I was trying to make myself, sorry. I think regulatory aspects play a very important role in terms of providing a framework to make sure that there is trust in the system. And I think regulators have a very strong role in that regard, because it is important for people who are buying our products and services, especially seeing as how their relationship is such a long-term one, for them to really understand that we're properly capitalized, that we have the ability to live up to our promises, and that we are transparent in terms of what we're doing. But I think at the same time, we need to find the right balance so that we can offer people the products and services that they need over the course of their life. The types of products that are being offered to people have shifted over the course of years, especially in the retirement area, from more defined benefit type products to defined contribution products. And we have a role in that transition to help people really understand what they're buying, because the decisions they make around it are quite complex, and we really need to make sure that people understand the consequences of these decisions, especially in going from accumulation to decumulation and making sure that they have the income to last them a lifetime.
Thank you, Mike. And before we proceed, we do have another question coming in. May I ask all our participants, instead of typing it in the question box, you can just literally click on the little hand icon that you can see and we will be able to identify you and unmute you so you can talk directly. I think the conversation will flow better that way. So if I can please ask you to do that. And on that note, we have a question from Gianfranco Viciet. Can somebody please unmute Gianfranco? Gianfranco, can you hear us? Hello? Perhaps not, but let me try and read out what the question was. And so it was, from recent researches and survey, we can observe an increased interest due to COVID-19 crisis of health and life insurance product. Which is your view? To an extent, I suppose that has been answered by some of the comments that you have made already, Kai and Mike. But I wondered if, Gianfranco, if there was anything specific that you wanted to bring in, any specific angle you wanted to add to that. But I don't think you can hear us. No. Okay, let's then move on. And while we wait for more audience questions, let's also ask a few more probing questions to you both. Kai, you are using life insurance penetration to illustrate the eroding relevance of insurance in a number of economies, and they're not undisputed methods. So can you elaborate a little bit on that?
I have to unmute myself. Of course. I mean, let me start with the reason why we are using life insurance penetration. It's the only available internationally comparable measure. That's number one. Number two is, the data available goes back various decades. So we have a time series, a relevant time series. That's the reason why we are using it. But of course, there are some shortcomings. One shortcoming is that some life insurance penetration ratios for individual countries are distorted by specific institutional factors. Think of South Africa. South Africa is the country with the highest life insurance penetration in the world, which reflects an institutional setup that very much relies on the retirement provision by the private life insurance sector. So there's an explanation for that, but you need to know that in order to make sense of outliers. The second aspect, more methodologically, when you compare GDP with premium volume, you make the assumption that there is a constant relationship between economic activity, which is measured by GDP, and the risk exposure, which is measured by premiums. This is a bold assumption given the times we are living in, given the fact that we are seeing a rapid transition to the digital economy, that we are seeing the replacement of tangible assets by intangible assets. So the underlying risk landscape is changing, and the relationship between premiums and GDP might not be as stable and meaningful as it was in the past. So these are some of the shortcomings of the measure.
Thank you. I'm looking for any raised hands before I ask, but then we do have a few other questions coming through to us. I think we have a question from Ayande Saha. With low insurance and pension penetration in a country, what should be the role of government in terms of public policy in promoting insurance and savings during these uncertain times? Perhaps I can get Mike to get us started, and then we will move to Kai.
Sure. I think here again, I think government really has a central role in terms of orchestrating the financial systems and retirement systems within their countries. I think they can, we spoke a few moments ago about regulation, they can make it possible through regulation and legislation for people to take advantage of life insurance. They can tax incentivize people to save for the long term. They can help companies in terms of also providing them with tax incentives to allow their employees save for the future. So I think they really have a very important role in terms of setting the environment that makes it advantageous for people to actually take action themselves and empowering people to do it. But also have a very big role from an educational point of view in making sure that governments help ensure that financial literacy is taught through the school system so that people understand and have a greater understanding of what's needed to make these decisions. But also they can play a role in raising awareness about the topic in general, about how important it is for people to prepare for their financial future.
Yeah, maybe Adrita.
Yes, of course. Kai, please go ahead.
Just one additional thought. I mean, Mike summed it up perfectly, but I would like to remind you a little bit, going back to history. I mean, I think macroeconomic policies matter greatly. Stable macroeconomic policies are a prerequisite to making people comfortable investing for the long term. And maybe most of us here at the call may not remember that until the 1970s, high inflation rates were actually a major drag on long-term savings, on life insurance. And life insurance started to take off. And this is also what you see on my first slide during the 1980s, when actually there was a successful fight against inflation worldwide, and inflation was basically defeated. But in the emerging world, for example, there are a number of countries where macroeconomic stability kills any life and pension market, you know, with a private sector role. So that overall macroeconomic stability, I think, is also a very important factor to consider.
That's great. We have another question that's been put forward by Nicholas Guy Picton Taylor. The marketplace is ripe for innovations and needs expanding into a whole life approach. How can this be proposed given the silos that exist between the banking and the insurance sector? Mike, why don't you have a stab, and then we can go to Kai.
That's a good question. I'm not sure what I have a single answer for, but I think you can see, and I know we as insurance companies do, or as an insurance company, I speak for ourselves, to work with banks as well to as a distributor of our products, because people have a long-term relationship with their bank. I know there's a statistic I heard many times in the past, people are more likely to get a divorce than to leave their bank. So, I mean, from a channel point of view, it's an interesting channel for us to work with banks to make sure that we can raise awareness about the products and services we have and offer them through the bank channel. It is a channel that we work through in many countries. I think in some countries it's a stronger channel than in others.
Maybe just an additional thought. I think in a number of countries, you can argue that you know, the lines have been blurring a little bit between what banks have to offer for long-term retirement versus what insurance have to offer. Because in the past, what really set insurers apart was the ability to offer guarantees. Right, and these guarantees especially for you know, macroeconomic reasons, but also for regulatory reasons, have become increasingly uneconomical to provide for life insurers. So you can argue that, you know, in terms of what they really offer to solving the customer's problem, the lines have been blurring recently due to these factors. And that, you know, the traditional role of life insurance is less clear than maybe 20 or 30 years ago.
Thank you both. Perhaps given the time that we have, and we have But I can't see any raised hands. We can proceed with another question. And I wanted to pick it up because Geneva Association's tagline is "Insurance for the Better World," and one of the areas I wanted to pick up was the socioeconomic, the demographic differences in terms of how people buy or perceive insurance. And Kai, you talked a little bit about the socio-demographic determinant of insurance demand, and I wondered if you would like to elaborate a little bit on that, and perhaps also within that, talk a little bit more about the affordability question, which sort of nicely ties in with that. Thank you.
Right. So these are two questions actually, but let me take a step. This, I mean, social demographic, socioeconomic factors were one of the three areas that I mentioned that need to be understood in order to make sense of actual buying behaviors. And financial literacy and educational levels, that's one aspect which we covered. But what we did not cover, for example, is the fact that in a number of advanced economies, middle classes have been eroding over the past few years. So we have seen a growing low-income segment and a growing high-income segment, but the middle class in between has been eroding. For the US, for example, there are interesting statistics, and that of course is bad news for life insurance, because for the lower income segments, affordability is the real issue. And for the wealthier segments, you can argue in principle they can self-insure. So that is a structural drag on life insurance demand, which we have not covered so far. And another aspect, of course, is that fewer people get married or stay married or have children. All these developments and these trends put pressure on life insurance demand and sales. And maybe your second question, the affordability, that's very interesting. And I wanted to make this point before, which I forgot. Many people indicate that they cannot afford insurance, life insurance. And at the same time, various studies show that people systematically overestimate the cost of insurance, term life insurance in the US. What people believe the cover costs is 3 times what it actually costs. So again, we are talking about very soft issues, awareness, knowledge that we as an industry can and must address in order to boost the demand for our products.
Mike, I wondered if you would like to add anything to that.
We have in our research, we definitely look at demographic breakdowns in terms of how generations look at the various different questions. And I think what we can see sometimes is, I think was an interesting fact that we were looking at the data a while ago and saw that sometimes you can see younger people are less good at predicting how long they're going to live. We ask questions about how long do you expect to live? How long do you expect to live in good health? And I think that's an interesting finding for the fact that it's important to really to be able to plan appropriately, have a good idea of how long you're going to live for and what the job is ahead of you. So I think that's an area where, and I don't really have an explanation as to why younger people aren't as good at predicting how long they're going to live. But I think it is an area where we do need to sort of raise awareness again about how things are changing and the important need for people really to make a plan and to make sure that they don't end up in that situation where we saw that they fall into the categories having a retirement concern that they're going to run out of money.
Wow. Well, thank you, Mike. And I'm afraid we are out of time, so we will have to stop here. But please continue to join the dialogue with the GA and our panelists using other forms. I'd like to take this opportunity to thank our panelists for your time and for sharing your insight, and also our communications and conferences team who has made this happen. And a recording of this, I believe, will be made available at some point. But until then, until the next one from the series, Goodbye, everybody, and stay safe. Thank you.
Thank you.
Thank you. Goodbye, everyone. Bye-bye.
Bye-bye.